One of the best ways to offset a Roth conversion is to use the real estate professional status. So this won't apply to everybody, but it will apply to those who are looking to acquire real estate in the near future, or those who have acquired real estate probably in the last 1 to 5 years to be best for the most opportunity and tax savings. So this is a strategy I've used with very savvy real estate investors who are retired and maybe they haven't touched their Social Security income yet, and they want to do a Roth conversion. So reason to do Roth conversion in the first place is to have less requirement distribution. So once you hit a certain age in your 70s, you are actually required by the IRS to take distributions from your traditional IRA, and so that creates a tax hit. So some people, what they like to do, kind of the sweet spot is in retirement, before you get Social Security, obviously before you are required minimum distribution age, then that might be a good time to consider the Roth conversion. And this is especially true if you're able to offset that Roth conversion. It's a no-brainer. So who's eligible for this? First off, you have to have at least 750 hours of material participation. So this probably won't apply if you only have 1 or 2 properties, especially if you use a property manager. It might apply, once you start getting 3 to 5 or more properties, and this will apply to your not your short-term rentals, but your mid-term rentals that are 30 days or more, and then also the long-term rentals market. It can apply to some short-term rentals. The average stay has to be more than the 7 days. So there are specific rules on the types of properties that would apply, and also how many hours you have to reach. Now, some people will try and say that they meet real estate professional status even though they're still working. That is extremely unlikely, especially if you're working full-time. If you're working full-time, you're probably working 2,080 hours or more every year. So it would be extremely unlikely that you can say you're working more hours as a real estate professional than you are in your W-2 job. It's probably something that's not going to pass the test if you're to ever get audited. Now, one thing to note is that California actually doesn't agree with the same rules as federal law. So it doesn't conform to federal law, meaning that if you do create a loss with real estate professional status, then it's going to be essentially zeroed out. So you might be able to offset all of your rental income with expenses, but you won't be able to take a loss for California. So that's extremely important to note, and it could apply to other states as well, depending on what state you live in. So this is kind of an interesting case study I did that shows the power of doing Roth conversion when you're doing real estate professional status. So let's just say married couple, they have $100,000 of dividend income, interest, stock sales, and then maybe they have a $100,000 pension, so $200,000 income before they've even done any kind of Roth conversion. That's not including any rental income. But let's just say, for the sake of this case study, that they actually have a tax loss when it comes to their rentals, and let's say they do qualify for the 750 hours. So just FYI, the real estate professional is only going to apply to one person, so each person has to meet it. So if one of the, let's just say David meets real estate professional status, then he is the one who's going to claim real estate professional status on the tax return, and then they're going to be able to offset that Roth conversion, and they're going to be able to offset any other income. So let's just say they want to do a $100,000 Roth conversion. Well, they can offset it just from meeting real estate professional status, and let's say they couple that with doing a cost segregation study. Cost segregation study is something that just accelerates depreciation. In short, it's an analysis done for the tax returns that you can put on there as part of your reporting, and it would offset the real estate income, and let's say that loss is created, and then we're able to offset a full $100,000 Roth conversion. So basically you've done the the conversion tax rate, at least on the federal level. Now remember, this isn't going to apply in certain states, especially California. It's still valuable, obviously, because if you are trying to do a conversion, then at least you're saving on the highest tax you're going to pay, which is going to be federal. So essentially with this case study, it's just to show you there's a lot of tax strategy out there that can be implemented, and this is just one of my favorite studies that can show you the power of real estate professional status. If you qualify, if you acquire properties, and you're able to meet that 750-hour test, and you want to do a Roth conversion for whatever reason, if you're trying to lower your requirement of distribution, or you have kids, if you want kids to inherit that Roth IRA without having to pay taxes on a inherited IRA, then it's just a great tool to have, and just to show you how powerful real estate can be.